Welcome back to the Deep Dive. This is the show where we take the biggest, loudest, most complicated topics out there and really just try to filter them down into clear, actionable knowledge for you. And today we are wrestling with a phrase that has, I think more than any other, become this sort of cultural shorthand for all our modern anxiety about the future. And that phrase is the Great Reset.
It really is. It's absolutely everywhere. I mean, you can be reading official policy papers from, the World Economic Forum, or you can find yourself in these really deep corners of the internet where speculation is it's running wild. And the phrase itself, it suggests this huge, coordinated, almost deliberate reordering of society.
Right. And for the average person, it feels like this terrifying choice. You're stuck between two extremes.
Yeah.
Either there's a secret plan being run by global elites, or we're all just hurtling toward a total, global financial collapse.
And there's no room for nuance in that kind of discussion.
Exactly. And that is the problem we're here to solve today. When the noise around a shift this big is this loud, how do you, the individual investor planning for retirement, or, the professional trying to get ready for the next decade, or just a curious person who wants some clarity, how do you maintain focus? So our mission for this deep dive is to be a shortcut. We're cutting through that superficial binary. This is not about choosing between, institutional optimism on one side and conspiratorial speculation on the other. We are going to analyze the Great Reset through a hard financial and a historical lens to understand what its real implications are for your wealth, for your privacy, and for the future of capitalism itself.
Because the forces driving all this change, they're immense, and they're very, very real. The global financial architecture, the rules of the game that we've all been operating under for the last 50 years or so, it's at a definitive inflection point. The Great Reset as a concept is really just the term that's been applied to the convergence of three vast, and I'd argue largely inevitable, cycles that are forcing this reordering to happen.
Okay, let's lay those three forces out right now, just so everyone knows what we're working with. First, there's this tectonic shift happening in corporate governance, moving away from a shareholder-only focus towards something called stakeholder capitalism. Second, you have this massive technological fusion, the integration of the digital, physical, and biological worlds. It's known as the Fourth Industrial Revolution, or 4IR, and that's redefining everything about how we interact with money.
And then the third force, and this one is arguably the most powerful because it's purely historical and inevitable, is the deleveraging of the long-term debt cycle. The global economy, and especially the largest sovereign nations, just has too much debt compared to its ability to pay it back. That force alone demands a resolution.
And this deep dive is built on an expert financial analysis. It's titled Excerpts from The Great Sovereign Reordering, Dissecting the Great Reset and the Future of the Global Monetary System. And our sources suggest this whole transition, driven by that debt and the new tech, could all culminate in what they call a Great Sovereign Reset, potentially around 2025. So this is not a time for fear. It's a time for cool analytical strategy. It's about building a resilient, maybe even an anti-fragile portfolio.
It really is. It requires separating strategic intent, the roadmaps that major institutions are putting out there, from the financial inevitability, the forces of economic history that, frankly, don't respect any political boundaries.
Okay, let's unpack this. Let's start with Pillar 1. This is the institutional architecture of the Great Reset, and it's mostly championed by the World Economic Forum. This is the ideological shift known as stakeholder capitalism.
Right. And this represents a really genuine, a fundamental redefinition of what a corporation is for. For the last half century, since the 1970s, we've pretty much operated under shareholder capitalism that was heavily influenced by economists like Milton Friedman, and that model was crystal clear.
Yeah, the only social responsibility of a business is to make a profit.
To maximize profit for its owners, the shareholders, that's it. Every decision, every single efficiency was bent toward that one goal.
And that focus, it drove incredible global growth and efficiency. But the critics would argue it also led to these massive externalities, right? Environmental damage, labor issues, prioritizing short-term financial gains over long-term health. So how exactly does this WEF stakeholder capitalism model change that mission?
It just broadens the scope dramatically. The shift redefines the corporation, not as just a profit machine, but as a social organism. It has responsibilities that go way beyond its owners, so it has to simultaneously serve all of its stakeholders. That means employees, customers, suppliers, the local communities, and this is the big one today, the environment. The focus shifts from quarterly profit to long-term sustainable value for that whole ecosystem.
Wait a minute. If they're trying to serve five different masters, isn't that just a recipe for paralysis? I mean, how do you measure success if it's not just the bottom line, the quarterly earnings? What's the actual mechanism that holds them accountable to all these different groups?
And that is where the ESG mechanism comes in. Environmental, social, and governance metrics. These ESG scores are not just some, feel-good ethical thing. They are the mechanical backbone of this entire transition. They provide a standardized, non-financial framework that allows asset managers, pension funds, banks, and eventually governments to quantify a company's performance across that broader spectrum.
Ah, okay. So even if a CEO privately thinks this whole stakeholder idea is nonsense, they have to care about their ESG score. Because the major global asset managers, the ones with trillions of dollars in capital, are using that score to decide where to put their money. Capital will literally just flow away from companies with bad scores.
That is precisely why it's a pragmatic necessity for survival, not just some ethical choice. The proponents, they argue that ESG is basically a long-term risk management tool. Think about it. A company with high environmental risk, low E score, is facing huge future regulatory penalties, climate disruptions to their operations.
Right. Or a company with terrible labor practices, a low S score.
Exactly. They face internal conflict, reputational damage, their supply chain could collapse.
Yeah.
So paying attention to ESG, the argument goes, is a signal of superior long-term corporate resilience.
And this whole institutional shift doesn't happen in a vacuum. It needs technology. And that brings us to the second part of their plan, which is the fourth industrial revolution, the 4IR. We're talking about AI, the Internet of Things, cloud computing, biotech, this complete fusion of the physical and digital worlds. How does that technology feed into the Great Reset?
Well, global coordination, especially around massive risks like climate change or pandemic preparedness, it's just impossible under the old fragmented system. The 4IR provides the tools you need for that kind of systemic management. The institutional objective here is to harness these technologies, especially AI and distributed ledger systems, for the public good, specifically to achieve those ambitious UN Sustainable Development Goals by 2030.
Can you give me a concrete example of that fusion? Like, how does AI or IoT connect to corporate governance or an environmental goal?
Sure. Think about the complexity of managing a global supply chain under really strict carbon emission targets. You can't do that with paper audits anymore. It's impossible. The 4IR means every asset, every delivery, every single energy input is tracked digitally with sensors. It's the IoT part, and it's analyzed instantly by AI. This infrastructure makes a green growth model possible, a world where resources are managed with precision, where carbon pricing can be enforced in real time, and where private investment can be directed effectively toward low-carbon infrastructure.
And things like the Reskilling Revolution Partnership, which aims to train 1 billion workers.
Right. That's necessary to make sure the labor force can actually operate in this new, technologically dense, automated, digitized economy. The 4IR is basically the mandatory operating system for stakeholder capitalism to even function.
That moves us perfectly into Pillar 2, which is, I think, maybe the most critical for our listeners because this isn't based on anyone's ideology or tech. It's based on macroeconomic inevitability. This is Ray Dalio's famous framework, the big cycle of debt and empire.
And this is where we pivot really sharply from the WEF's strategic roadmap to just cold, hard financial reality. Dalio's framework, which is based on centuries of economic history, argues that global systems operate in these predictable cycles, usually spanning, 50 to 100 years.
Yeah.
And these cycles are defined by the rise and fall of great powers and, critically, the boom and bust of the long-term debt cycle.
Right, and we've had this massive expansion since World War II, all built on increasing levels of debt. So where does Dalio argue we are right now in that cycle?
We are firmly in the late stages, the part where the system starts to approach its natural breaking point. These cycles always end when the cumulative debt burdens, and by that I mean global debt to GDP ratios, become so enormous across countries, corporations, and households that the traditional tool of central banks,
And cutting interest rates.
cutting interest rates, exactly, it just doesn't stimulate the economy effectively anymore. You hit what's called the zero lower bound, where rates just can't go any lower.
So once rates hit zero, the central banks they're basically out of their normal ammunition. What's the forced response then?
The forced response is unconventional monetary policy, primarily quantitative easing, or QE. The central bank is forced to print money electronically and inject it into the financial system, specifically by buying up financial assets, mostly long-term government bonds, sometimes mortgage-backed securities.
Okay, Help us really unpack the mechanism of QE for the listener, because you said earlier it structurally widens the wealth gap. Why does that happen?
This is the critical juncture. QE is designed to push down long-term interest rates and flood the banking system with liquidity. But it has this devastating side effect on distribution. When the central bank buys up all these assets, it inflates the price of those assets. And that drives all the remaining money into other financial assets, stocks, bonds, real estate, high-end art. And since the wealthiest 10% of the population owns the vast majority of those assets, QE is functionally an asset price inflation machine that flows directly and primarily to the haves.
Hold on. So the central bank's big effort to save the economy from collapsing by printing money is, at the same time, acting as this gigantic structural wealth transfer machine, one that just intensifies the separation between the haves and the have-nots. That sounds incredibly destabilizing.
It is inherently destabilizing. QE, it buys time at first by keeping the system liquid, but it structurally makes inequality worse by inflating asset prices way faster than wages or the price of goods. And that leads to the inevitable deleveraging imperative. The debt has to be reduced. And history shows us there are only 4 ways to do that, and none of them are pleasant. There's austerity, politically disastrous spending cuts. There's debt restructuring, which is painful for creditors. There's money printing, which leads to currency debasement. Or there's conflict, war, or revolution.
So the Great Reset, from this historical Dalio perspective, isn't some shadowy plot. It's just the label we're putting on a historical event, a massive systemic deleveraging that has to happen because the debt has just become mathematically unsustainable.
Precisely. It is a historical inevitability. When global debt-to-GDP ratios get to where they are now, these historic highs, policymakers, of course, they hope for a beautiful deleveraging, a slow, managed reduction through growth and some inflation. But the wealth gaps and the political tension that comes from them make that highly unlikely, and that raises the risk of an ugly, chaotic deleveraging, which history shows is, unfortunately, far more common.
And that debt-driven inequality leads directly to the political feedback loop you mentioned. When the wealth gap gets this extreme, conflict intensifies, which makes any kind of cooperative solution really difficult.
Yeah, Delio's research on the 1930s, for example, it shows that these extreme wealth and value gaps, which are very similar to what we're seeing today, are powerful breeding grounds for populism, for nationalism, for internal disorder. You see the rise of these populist leaders who, whether they're on the left or the right, are just more inclined toward conflict, and they're less willing to compromise on painful economic fixes. And this political instability actively undermines the global cooperation you need for a stable, managed transition. It just raises the risk of social unrest, civil conflict, and potentially authoritarian measures designed to keep order at any cost.
This inherent fragility moves us perfectly into Pillar 3, the broken money crisis and technological responses. This part focuses on the nature of money itself. Lynn Alden, a great macro analyst, describes our current situation as broken money. What does she actually mean by that?
Well, money, at its core, is a technology. It's a technology for settling value and for storing economic energy. The crisis we're in now is partly a technological mismatch. The speed of telecommunications, instantaneous transactions across the globe, has just vastly outpaced the speed and, more importantly, the integrity of our settlement layer. Our current centralized fiat system just isn't built to handle the pace of the modern global economy without being constantly manipulated or debased by the central authorities who issue it.
And the symptom of that brokenness is this shift to what you call fiscal dominance. That's a crucial concept for listeners to get because it fundamentally changes the role of the central bank.
Fiscal dominance is the critical distinction of the current regime. We've shifted away from the ideal of monetary dominance, where central banks were independent and could control the economy with interest rates. Now we're in fiscal dominance. In this new world, it's government spending, these massive, politically motivated structural deficits that is the overwhelming engine driving the economy, regardless of inflation.
Wait, so if the government is spending trillions more than it brings in, the central bank is basically forced to accommodate that. They lose their independence.
Exactly. They are compelled, both politically and financially, to monetize that debt. They have to keep interest rates artificially low, or just print money to fund the ever-growing government deficits. This is why the environment is structurally inflationary. The money supply must grow to accommodate the sovereign debt, regardless of what the real economy is doing. And this process, this forced debasement, it structurally makes your local currency an unreliable long-term store of value.
So for the average person in the US or Canada or the EU holding dollars or euros, Their long-term saving experience starts to look a lot like what citizens in high inflation countries like Argentina or Turkey have had to deal with for decades. Your local currency just isn't a long-term savings tool anymore.
That is the core realization of the broken money crisis. As the money itself becomes unreliable, the demand for truly scarce, decentralized assets as a way to protect your purchasing power, it surges.
And the state's institutional technological answer to this crisis of trust and this tech lag is the Central Bank Digital Currency, the CBDC.
Right. Over 130 countries are exploring CBDCs right now, and the institutional sales pitch is pretty compelling. They say they're necessary tools for financial inclusion, for modernizing archaic payment systems, for increasing the efficiency of monetary policy. But for the individual, they represent a profound shift in the relationship between the state and their personal finances.
Okay, let's address the core concern head on, the one that drives so much of the anxiety, the surveillance risk. How do CBDCs fundamentally change privacy compared to, say, using cash or even just your regular commercial bank account?
Physical cash offers high anonymity, at least for small transactions. Your commercial bank account, while it's tracked, it operates through this decentralized network of private institutions. A CBDC, depending on its design, could create a single, unified ledger where all data, all transaction histories, all behavioral patterns are aggregated and instantly accessible by the Central Monetary Authority.
The Bank for International Settlements, the BIS, they often talk about privacy by design, but in the same breath, they stress the need for integrity, anti-money laundering, compliance. Those two goals seem to be in direct contradiction.
They are deeply contradictory. And the surveillance potential goes way beyond just monitoring transactions. If this infrastructure is deployed in a nation without extremely robust democratic and legal protections, the CBDC infrastructure could potentially be leveraged for social control. It could integrate financial data with personal metrics, like a social credit score.
Which brings us to the feature that causes the most fear in the market, programmability. Can you give us a layered explanation of what this means in practical terms, beyond just the simple definition?
Of course. Programmability is the ability for the monetary authority to potentially embed restrictions or even expiration dates into the currency itself. We can think about it in maybe three layers. The first layer is use restriction. The currency could be programmed to restrict who can purchase what. So say, limiting purchases of foreign currency or specific commodities. The second layer is expiry. The currency could have a use it or lose it date to force consumption and stimulate the economy.
And the third layer, the most powerful and concerning one.
That's the ability to link it directly to policy goals. So for instance, if a government wants to enforce specific climate targets, they could theoretically program the CBDC to enforce individualized spending limits on high-carbon goods, or limit mileage allowances on gasoline, or even restrict the currency's use to certain approved vendors or regions. This feature is really the pinnacle of the institutional reset because it provides the state with unprecedented granular control over the economy and individual behavior. It makes financial sovereignty a much, much more challenging goal for the average citizen.
That's a fascinating and, frankly, chilling point. The technology now exists to give the state the capacity to enforce the goals of stakeholder capitalism right down to the individual level. Okay, now that we've set up the three pillars, the institutional drive with ESG and 4IR, the historical pressure from the debt cycle, and the tech response with CBDCs, we need to spend some serious time decoding the narratives around them. We have to separate the conspiracy myth from the legitimate financial trend.
This is so important. The information warfare around the Great Reset often works by taking a real, factual, technical trend and then twisting it into a wild, conspiratorial claim. It makes it almost impossible for the average person to know what's true.
The most famous example, the one we hear constantly, is the ownership narrative. The claim that global elites are planning to abolish private property and enforce some kind of corporate feudal state. The simple, chilling version is, you'll own nothing and be happy.
And we have to track where that came from. It came from a 2016 thought experiment, a blog post by a Danish parliamentarian named Ida Auken. It was titled Welcome to 2030. She was describing a fictional city where technology had made physical ownership obsolete because accessing services was just so incredibly efficient.
So the myth is this deliberate, coordinated master plan for asset seizure, the end of private property. What is the powerful, factual, economic reality that this narrative is twisting and sensationalizing?
The reality is the massive, legitimate, and investor-driven growth of the product as a service model, or PaaS, in the circular economy. This is not being driven by some government mandate. It's being driven by a corporate desire for stable, recurring revenue and by the need for radical resource efficiency in a constrained world.
Give me a real-world corporate example of payas so the listener can really grasp this profound shift in how capital is allocated.
Okay, consider industrial infrastructure. Historically, a factory would purchase a massive air compressor or an expensive heating unit. That's a huge one-time upfront capital expense. In a palace model, that same industrial provider, say a Rolls-Royce with their jet engines or an infrastructure company, they retain ownership of the asset. The factory doesn't buy the compressor. They pay a predictable long-term service fee for guaranteed high-quality air compression or engine hours. They're paying for the utility, not the asset itself.
So the company keeps the asset on its balance sheet, which creates stable recurring revenue, and the customer just pays for the outcome. How does this fundamental business shift impact the average person's ability to build wealth?
It creates two major structural changes. First, it concentrates asset ownership cars, major appliances, industrial gear, even software, think Adobe, moving from selling boxes to selling subscriptions. It concentrates all that ownership onto corporate balance sheets. Second, for the individual, the capital that you once would have put toward owning a physical, tangible asset is now redirected toward perpetual service fees. This shifts the individual away from accumulating collateral and equity in physical goods and toward just consuming utility. It profoundly changes who holds capital and who holds debt.
So it doesn't mean your house will be seized.
No, but it means wealth accumulation through traditional asset ownership becomes much, much harder for the middle class.
That really clarifies the structural shift. Now let's talk timeline. Some analysts are suggesting that 2025 is the looming deadline for a sovereign reset. Why that specific year?
That timing is really driven by the acute stress in sovereign debt markets. Remember, Pillar 2, the system is just overleveraged. Analysts point to 2025 as a critical period because the current debt structure is just mathematically unsustainable, and you have this convergence of debt maturity schedules. Central banks need a mechanism to restore their balance sheets without triggering a chaotic global default, which would just shatter the whole financial system.
And the most dramatic but still widely discussed proposed solution involves the gold revaluation proposal.
This is a radical framework, but it's economically sound, given the constraints we're under. The mechanism involves central banks engineering a massive revaluation of their gold reserves. Central banks still hold gold on their books at these historical artificial prices, often around $42 an ounce. The proposal is to change that official price to a market clearing price, which some analysts estimate would need to be around $8,000 an ounce, or maybe even higher, to fully back the global debt.
So the gold revaluation is basically an accounting trick, but it's one that provides immense instant liquidity. It's a way for central banks to restructure or retire a huge chunk of their national debt without a chaotic, confidence-destroying default.
Exactly. If a central bank revalues its massive gold stock by that much, they suddenly have these colossal instant accounting gains on their balance sheet. And this liquidity provides the buffer they need to manage the sovereign debt crisis and stabilize the system for the next phase. It's a clean slate mechanism.
And as we shift into this new financial phase, which will be all about programmable money and CBDCs, we're going to need a bridge to connect all these different national systems.
And that's where neutral digital bridge assets come in. Some proposals explicitly mention assets like XRP because they are designed for instantaneous, frictionless cross-border settlement and liquidity. The goal is to allow global trade and finance to just continue seamlessly between all the various national CBDCs, stablecoins, and tokenized assets.
So for the average retail consumer, this massive transition to programmable rails, the tech infrastructure of the Great Reset, could happen almost invisibly because this sophisticated bridge asset is managing everything on the back end of the financial system.
It allows the transition to happen smoothly while national governments are still trying to figure out the deeply contentious consumer-facing policies of their own CBDCs. And that 2025 timeline gets some non-financial pressure from a moral perspective, too. It coincides with the Catholic Church's Jubilee year, which is fueling the Jubilee 2025 movement, a major global campaign calling for unconditional debt relief for the world's poorest countries.
So you have this convergence of financial necessity and a moral imperative.
Exactly. It creates intense political pressure on institutions like the IMF and the World Bank to address the systemic debt crisis by that specific year.
Okay. Let's pivot now to the part that matters most for you, the listener, in the spirit of building financial resilience. We've seen the forces: fiscal dominance, currency debasement, institutional reordering, technological upheaval. The new mandate for the individual investor is simple. Portfolio resilience is the new mandate.
Absolutely. In an environment where central banks are essentially forced to print money to fund chronic government deficits, just holding traditional cash or traditional fixed income instruments, things that rely on stable interest payments,
Hmm.
that is a guaranteed path to purchasing power erosion. You are being systematically taxed by inflation. Your wealth strategy has to adapt to a world that's defined by monetary volatility and systemic change.
Let's start with the fundamental hedge for this transition, the digital versus physical hedge, gold and Bitcoin. These are the two primary choices for externalizing your wealth from the traditional banking system.
Gold is the classic anchor. It remains the ultimate protection. Central banks are continuing to accumulate gold. It's recognized globally as a zero-risk weighted asset for sovereign protection. It's sanctions-resistant, historically accepted, and it serves as the foundation for hedging against sovereign and currency risk. It is a necessary part of any anti-fragile portfolio.
But Bitcoin is the new player. It's the digital gold of the fourth industrial revolution. What specific role does it play in a reset scenario, and how is it different from just holding gold?
Bitcoin is fundamentally different because it's a completely decentralized, censorship-resistant technology, and it's capped at 21 million units. Crucially, it bypasses the traditional banking and CBDC systems entirely. So while it has much higher volatility than gold, its core value proposition is its absolute scarcity and its resistance to government seizure or control. For anyone anticipating capital controls or extreme currency debasement, Bitcoin is a necessary high-upside diversifier.
So it's not a choice of one or the other. It's about a strategic allocation based on your risk tolerance and what threat you're hedging against. Gold hedges historical systemic chaos. Bitcoin hedges technological centralization and digital surveillance.
Exactly. A diversified approach is key. Gold provides the stability and central bank credibility. Bitcoin provides the censorship resistance and leverage against the digital scarcity premium of the 4IR.
Okay, beyond the monetary hedges, where should we be looking to deploy capital in this fiscally dominant inflationary world? The focus shifts to real assets and intangible value.
You have to move toward assets that provide a natural hedge against inflation and geopolitical instability. We're talking about infrastructure things like toll roads, fiber networks, data centers, select real estate, so strategic, highly liquid properties,
Yeah.
and commodities, specifically focus on commodities like aluminum, copper, rare earths, the essential inputs for the fourth industrial revolution technologies and that green growth model. They're going to see demand surges. These are assets that cannot be printed into existence.
And if we look at the equity markets, we need to focus on companies that can not just survive, but actually thrive in this new paradigm, this service-oriented pass-S economy.
That means favoring circular economy stocks, companies that have successfully adopted the product as a service model. And why? Because they shift away from volatile, volume-based sales and towards stable, predictable, recurring revenue streams. Think about software companies that moved to SaaS, or industrial firms that shifted to selling utility rather than equipment. Their stability will be highly prized in an inflationary, uncertain world.
We also have to acknowledge that corporate value itself is shifting away from physical things like plants and equipment. So we need to focus on companies that are successfully stewarding their intangible assets. These are the new drivers of competitive advantage.
That is absolutely critical. Intangible assets, things like intellectual property, brand value, proprietary data, human capital. They now account for well over half of the market value for major firms. How a company stewards these non-physical assets is a direct indicator of its long-term health and resilience. It is a telling statistic that 15 out of the 17 S&P 500 bankruptcies between 2005 and 2015 were in companies that had poor ESG scores 5 years before they collapsed.
Wow, that statistic is a powerful argument for taking the underlying risk management part of ESG seriously, even as we see all this intense political friction around the topic. Let's address that friction, navigating the ESG backlash.
Yeah, by now the ESG movement is highly fractured, especially in the U.S. You see significant political backlash. Critics call it woke capitalism, or they allege antitrust concerns among large asset managers who collaborate on climate goals. This has led to institutions actually withdrawing from joint climate initiatives to avoid litigation and political heat.
And we're seeing this thing called green hushing. As a result, companies are doing the right thing operationally, but they're refusing to talk about it publicly.
Correct. They're de-emphasizing their public ESG marketing to avoid the political fallout. However, and this is fundamentally vital, investors must not mistake the political noise in the U.S. for the global regulatory reality.
Help the listener connect the dots there. What's the difference between the U.S. political rhetoric and the global reality?
The difference is regulatory jurisdiction. International standards, particularly the European Union's Corporate Sustainability Reporting Directive, or CSRD, require massive mandatory disclosure of ESG metrics from all companies doing substantial business in the EU. And that includes nearly all major multinational U.S. corporations. Plus, you have state-level laws like those in California that continue to exert massive pressure. So understanding ESG risks remains absolutely crucial for assessing a company's long-term viability, for accessing international capital, and for avoiding future regulatory fines, regardless of who wins the political debate in Washington.
So, for the individual investor who is seeking financial sovereignty, the goal is clarity. Ignore the rhetoric and focus on the underlying fundamentals. Does the company manage its intangible assets well? Is it preparing for the inevitability of carbon pricing? Is it positioned for the 10S economy?
That is the path forward. Financial sovereignty depends entirely on anticipating these historical and technological patterns and maintaining strategic discipline. It's about adapting to a future that's defined by a volatile monetary transition and a more centralized, yet paradoxically more service-oriented economy.
So, what does this all mean for the roadmap ahead? Our deep dive today, I think, confirms that the Great Reset is not one simple narrative. It is a powerful confluence of long-term cycles. The long-term debt cycle is demanding a resolution. Technological capacity has surged with the 4IR, and global institutions are trying to guide this inevitable chaos through stakeholder capitalism and the technical infrastructure of CBDCs.
The key to success, the core takeaway here, is separating the institutional intent, what the WEF and the CBDC proponents want to achieve in terms of centralized governance, from the macroeconomic reality. What the forces of historic debt and broken money demand must happen. The debt has to be addressed, and that requires a reordering.
And as we look toward this future, one defined by systemic transformation and technological monitoring, we have to pause on a final, provocative thought, something that builds on the institutional intent of the reset.
This is what you could call the neo-medieval risk. The institutional reset, particularly fueled by the 4IR and CBDCs, elevates specific, measurable goals like planetary health, resilience, and equity above our traditional definitions of individual financial liberty. But what happens if participation in this new economy becomes contingent upon your adherence to these centralized, measurable standards?
Right. If everything, your carbon footprint, your digital health metrics, your consumption patterns, is tied to your digitally programmable currency, you move away from the financial pluralism of the modern banking era. You move toward a system where economic participation is conditional. Could this lead to a new kind of stratification, where your ability to transact and build wealth is dictated by centrally managed compliance metrics?
It raises what is probably the most profound question of the decade. How do we successfully balance the undeniable need for resilience, for systemic stability, and for planetary sustainability with the fundamental human demands for individual liberty and financial privacy in this new, technologically integrated order? That tension is going to define the next chapter of human history.
Use this clarity to build a resilient, decentralized portfolio. Anti-fragility is the ultimate wealth metric now. Don't be swept away by the noise. Instead, anticipate the historical patterns and position yourself strategically. Thank you for joining us for this deep dive into the sovereign reordering. We'll see you next time.